Hi, friends. Welcome once again. So, at this point, we'll be looking at we're wrapping up the consolidation, the group account IFRS 10. We're going to mix it with IAS 28 associates. Okay, we cannot do group account without looking at associates. In this segment, we are looking at three different three different sections. So, we're looking at the consolidated income statement. Usually, you'll find it being classified as consolidated statement of profit or loss. Okay, so we're looking at that one as one segment. Then we'll look at associates as another segment. And then we'll look at the fact that sometimes we acquire these companies as a parent company. The company is not functioning as we would have wished, or for some good reasons. Sometimes even the company may be functioning as we want, but for some restructuring, merging, and acquisition issues, or some other operational issues, we want to sell it. We want to dispose it off. Okay. The same principles that we know in assets disposal will still count over here. When we deal with associates, it's quite pretty easy, very easy. The same principles we've used in the subsidiary consolidation is the same thing we'll be using here. And again, when we're looking at the consolidated statement of profit or loss, the same principle we have used in consolidated um, statement of financial position will be used here. What I want to say is that, listen, it's quite easy to do this thing. The only thing is that the more you practice, the better. Sometimes as you practice answering the questions, you get confused. Confusion is part of the learning process. So when you studying and you get stuck along the line, you are confused. Get to know it is part of the learning process. Okay. If you find everything easy, then what would you be learning? Okay. So it's part. Don't be confused. If you are confused, don't be worried. Okay. I'm not saying don't be confused. If you are confused, don't be worried. It's part of the learning process. Once you understand, you get over the confusion. You see any question of that nature anywhere, whether in practice, whether in academia, whether in an exams, anywhere, you'll be able to deal with it. Okay. So the first section or segment of this video, of these sessions, will be with a consolidated income statement or consolidated statement of financial position. All right. So let's kickstart. Let's kickstart. All right. So I'm going to present this. I'll try to do the illustration as much as possible along the line with my interactive pen, and hopefully you all benefit. Let's kickstart. All right. So at the end of the day, we want to be sure we can prepare consolidated statement of profit or loss, or consolidated statement of profit or loss and other comprehensive income. Some books you see they're asking you to prepare the consolidated income statement and other comprehensive income for a single group, okay? Where we deal with an acquisition in the period and recognition of the NCI as usual. We also look at the effects of intra-group trading, okay? And then we'll look at the effects of any fair value adjustment on our PP or any other item of non-current assets, inventory, okay? And then we'll also look at any assets or liabilities which had not been included in the subsidiary's own statement of financial position. Then we'll account for goodwill impairment. Any questions that pop up along these lines, we should be able to answer. You would think it's a lot, but it's not a lot. When we go through with the summarized slides, you will better understand that it's easy to practice this. Okay. We'll do more examples in class. And we'll find time, revision time, to do more of such examples, such works. So you'll be fine. Okay. So let me give you an overview. So like I said, the pro forma, usually, for our group statement of profit or loss, we're looking at the intra-group. Same principles hold. Okay. Where we eliminate. Okay. And then non-controlling interest, valuation of it, as we have already known. What else do we need to know about it? An impairment of goodwill, okay, and fair value adjustment, which we know, and then POC adjustment. So it's nothing new. But what do we do when it comes to the profit or loss account, not the balance sheet? What do we do? Okay. The basic principles in terms of mechanics, okay, of this particular section is first to combine line by line item of the parent and the subsidiary in terms of the income and expenses and any other comprehensive income line by line item. You consolidate them, add them up, okay, like we used to do in the statement of um, financial position. The same thing, okay. We then have to remove any intra-group items. Any intra-group items. Remember, we are still dealing with groups, okay. So such as trading. Now, Over here, any intra-group trading where we sold to one party within the family, within the group, we normally knock it off against the revenue because one person has recognized it as a revenue, okay, and the other person as a cost of sales, okay. So these two elements must knock off. So if I'm deducting 10,000 from my revenue, the same 10,000 goes to the cost of sales for the group, okay. Any dividends we've received from the subsidiary, we need to remove that one as well, okay. And then we look out for the and then again, another principle in terms of mechanics is that any adjustment, okay, pop, any unrealized profit provisions, we normally increase the cost of sales. Okay, remember, it's a profit someone has recognized on the sale he's made. To me, it's more or less the one who is buying have incurred more or less a cost. The person has recognized some kind of profit. Knock it off. Okay, knock it off. Increase it to my cost of sales and knock it off from the total revenue. Okay, fair value depreciation. Usually, you'll be asked to charge it to the cost of sales. Okay, normally we normally charge it to the we add it to the cost of sales. But read the question carefully. Sometimes they will ask you to include it to the operating expenses or distribution expenses, depending on the kind of asset which is under consideration. Okay, and then impairment, we charge it to administrative expenses or operating expenses. All right. Then finally, we want to split the profit for the year, okay, between the parent and then the NCI. And also we want to split the total comprehensive income, TCI, between the parent and then the NCI. Normally the NCI portion is calculated. We don't calculate that of the parent. The difference becomes that for the parent, okay? Quite easy, okay? All right. So let's take, so far we would be doing another calculation for the non-controlling interest portion of their portion of the total profit and then the total comprehensive income. That's the only thing we'll be introducing here. The rest we already know in terms of POP adjustment, POP calculations, okay, whether on PPE or inventory, we know it, okay. So usually, and I've put an asterisk here, the subsidiary's profit after tax or the profit for the year is what we bring up, okay. And then if there is any unrealized profit, where especially the subsidiary is the one who sold to the group, we subtract it, okay. Any fair value adjustment as a result of acquiring the subsidiary, we adjust it, okay. We subtract it, especially in the area of depreciation, okay, because at the end of the day, these must reduce the profits of the subsidiary so that we can get a real picture, okay. So if there is any profit that the subsidiary has recognized on goods he has sold to the parent, it shouldn't have been sold. It's a group business. It shouldn't have been sold. So deduct it so that we get a real picture, okay? Similarly, if there's any depreciation, the assets that we acquired from the subsidiary, the fair value at acquisition is actually higher than what is in the books. We'll depreciate. Depreciation. The subsidiary has not recognized it. We must recognize it, okay, and notify him that, listen, your assets actually, the fair value exceeds that of the book value, that of the carrying amount. So there's a depreciation component you need to keep in your books. So subtract it from your profit to get a real picture of the profit that you're supposed to report. Any impairments, subtract it, of course. You know, impairment will reduce profits, okay? And then we get our adjusted profit for the year, okay? Adjusted profit for the year. From these, assuming there is no other comprehensive income, these we look out for the NCI's portion and attribute it to him, okay? But if there's any other comprehensive income, we add it up. Whatever we get as the total comprehensive income, we assign the percentage of the NCI to him. All right. Now, the question is, there's asterisk, okay? Where acquisition takes place midway, we need to do some pro rata calculation. Actually, the profit there in that situation, if it is midway, refers to the profit, we only have to take care of the post-acquisition element, okay? So the subsidiary's profit after tax will represent the post-acquisition element, okay? We'll look at an example where there is a midway calculation, okay? Midway acquisition. Then we'll look at this, all right? So this is typically the main calculation we'll put in. The rest is something we already know, okay? All right, let's move on. So take this typical example. We're talking of on 1st April. So like I said, I always look at the dates so that I don't get outwitted. On 1st April, Prince acquired 75. So that's a subsidiary of equity shares of Sheena. The summarized statement of profit or loss and other comprehensive income for the two entities for the year ended. So I always look at the date. 1st April 2013 to 31st March 2014. It's one full year. It falls in line. Right. Okay. So the revenue, assuming there is nothing else to be done, we would have just added them. Okay. Cost of sales, we would have just added these two elements. Okay. These two costs of sales. Okay. Then we'll recalculate this. Okay. Even if you add it, you still get the same answer. Okay. Distribution expenses, admin, investment income. It goes to the parent only. Subsidiary has nothing. Finance cost, profit before tax. Taxation is given. Remember, we will always add this. We don't have to recalculate only unless you've been given specific percentage to apply. Okay. But normally it rarely happens. Remember that income tax expense we see here are usually provisional. They do not reflect the actual. If you remember in your advanced financial management, you realize that the company may adopt a different depreciation policy, for example, like a straight line, which increases its expenses and reduces the profit. But when it gets to the tax authorities, they will always change. They will say, no, we will not allow you to use straight line. We want you to use reducing balance. Then at the end of the day, you can claim your balancing charge from the written down value of the assets. Okay. So any income you see, any income tax you see here is provisional, just for the books. The real tax schedule will be prepared. Then you look at this. Okay. I'm sure you will meet this in your business taxation in your AFM, which we have looked at. Okay. All right. And then in this question, there is another element of other comprehensive income. Okay. So gain on revaluation of the land. So there is a other comprehensive income element there. Otherwise, we would have ended here. But there's a other comprehensive income, which we need to consider. Okay. Now, there are some footnotes which have been given. Let's look at this and analyze them. All right. So we are told that during the year, Sheena, the subsidiary, sold goods to Prince for 40,000. These goods had cost the subsidiary 30,000. So in effect, he has recognized how much? 10,000 profit, right? Here we're not giving you markup or margin. They've told you that it cost the subsidiary 40. He sold it for 30. He sold it for 40. He's recognized some profit of 10,000. Okay, 12,000 of these goods remained in the parents' books. Who tells you that of these 40,000, a chunk has gone outside of the group? That we must recognize. The question is, what percentage then remains within? Okay, so you simply could find 12 over 40. Okay, to tell you how much is outstanding. Okay, so 12 out of 40. Yeah. So 12 out of 40. Okay, 12 out of 40. So 12 out of 40 tells you that it's 30% remaining. Okay, 30%. Now, these 12,000 we have over here includes a certain profit element. For the total 10,000, there's no need for us to now consider because part has gone out. Okay, part of this profit has actually gone out of the group, so we can recognize it. But the remaining 12 out of the 40 which has been sold, 30% outstanding, is what we need to now consider in our POP calculation. Okay, all right. At the date of acquisition, Sheena's assets were carried at a fair value with the exception of an item of a plant whose fair value of 20 is above its carrying amount. There's no mid-year, so I'm just going to work it straight. No prorata, anything, okay? At this date, the remaining useful life is 5. Again, so it will be what? 20K divided by 5, which gives us 4,000, right? As a fair value depreciation. Right. Good. On 31st, the subsidiary paid a dividend of 4,000. Remember, we don't own every part of the subsidiary. the Sheena is a subsidiary, right? We own 75, okay? So simply, I'm going to get my 75% of this, right? I'm going to get my 75% of this, okay? Okay, so that gives me 3,000. So it means the parent portion is 3,000 as dividend, okay, from the subsidiary. Keep this. What do we do with it? All right. The Prince policy is to value NCI at fair value at the date of acquisition. Okay. Assuming we want to calculate the goodwill, we use this. Okay. Goodwill of the subsidiary has suffered impairment during the year for 5,000. Any impairment of goodwill, charge it as administrative expenses. Okay. Now let's move on and calculate. Remember, the goods that is sold to the parent was 40,000. So I sold everything to the parent and recognized in my books as revenue. So first and foremost, that 40,000 was like revenue to the subsidiary, but cost of sales to the parent. So on both ends, we subtract 40/40. Okay? Then we adjust for the pulp and for all those elements. Okay? All right. So let's move on. Workings. Let's look at the workings. So like I said, this gives us 30%, okay, of the profit element, okay, of these 10,000 which we had. It gives us 3,000, okay. You could use the other way around. You could use the other way around because if you simply want to find the item was 30, okay, 30,000 by 40,000 gives us 75,000, okay. Sorry, give us 75, okay, 75%, out of which the remaining 25% is what was a profit element, okay. So the item was actually 30,000 and we sold it to you for 40,000. And simply you can see that we added a 25% markup to get this, okay, to get that particular figure that we're looking for. So, okay, so you could use another dimension and then find it out of the remaining portion of the goods. So the POP remains as 3,000, okay. Fair value depreciation, I think I showed this in the working, okay. And then the investment, I also showed you this in the working, that we're taking only 75%. Now in the NCI calculation, we want to see the portion that should be attributed to the NCI. Okay, something is pop up on my screen. Let me close it. Okay, so we need to now need to look at which profit should be attributed to the NCI. Okay, which profit needs to be attributed to the NCI. So the Sheena's profit for the year, we pick it directly from the books. Let me go one step back. Profit for the year, 66. Okay, profit for the year, 66. Out of these 66, we put everything there. Okay, that's the profit for the subsidiary. Now we subtract the POP. Remember, it was a subsidiary who sold to us. Okay, remember, it was a subsidiary who sold to the parent. Okay, and when we recognize these, simply knock it out from the POP, from the profit element of the subsidiary, which he has recognized. Fair value depreciation, again, I said, it deals with a subsidiary. You know, he's had something he didn't recognize. We have recognized it in the books that fair value is higher than the carrying amount. So what you need to do is to get rid of the depreciation which you've not recognized, okay? Impairment is everything. One thing we should note here is that the goodwill of Sheena had suffered impairment. So it is the impairment value applies to the parent's holding in the subsidiary. Okay, even if there is a midway prorata, even if there's a midway acquisition in terms of prorata, you don't have to. It is my share, okay, in the subsidiary which is impaired. Doesn't have to do with any timeline. Knock everything off. Okay, so the whole of this knocks off from the profit element. Then we get this adjusted. So just apply the 25% which relates to the NCI. You get 13,500. Okay. Add the other comprehensive income of the subsidiary, we get 55,000. And again, you could easily get 25% of this 55 relating to what? The NCI. With this in mind, we can now prepare the consolidated statement of profit or loss for the parent company. Okay, for the parent company. All right, let's start. So this we have, this revenue is that of the parent, okay, plus that of the subsidiary, minus the goods which was transferred, the full amount, the 40, okay. the intragroup trading element, okay, the entire amount 40, because this guy, when the subsidiary sold to the parent, he recognized it as revenue. Okay, so everything must be knocked off. The corresponding goes to the cost of sales. Okay, so subtract it from the revenue, subtract it from the cost of sales. That's the first point. The next point is that the cost of sales, this for the parent, this for the subsidiary, we've already knocked this off, plus the 3. The 3 is the unrealized profit, okay? The unrealized profit we calculated here, which is still outstanding in the books. So add it, okay? Plus the 3, and then the fair value adjustment. If you are not told in the question, keep it under cost of sales, okay? So it is that of the parent cost of sales plus the subsidiary plus the unrealized profit. You have recognized it as profit, but in reality, it's not supposed to be a profit element. It's a group thing. It's a family business thing, okay? So add it to the cost of sales and knock it off from the profit of the revenue of the company, of the whole group, okay? Depreciation, of course, even if you bring it here under the operating expenses section, it will still reduce our profit, okay? So you keep it there as cost of sales, all right? So then we will recalculate our gross profit, okay? Distribution expenses are them. Just add the 2 lines, that of the parent, that of the subsidiary, okay? Admin expenses, we were told that impairment goes into the admin. Let's go back one step and see, okay? Impairment of 5,000 should be charged as administrative expenses, okay? That is why we are finding that of the parent, 27, plus the subsidiary, 23, plus the impairment expense, impairment of the subsidiary as an expense, okay? Investment income, okay? It tells you that this particular investment item that we found in the books of the parents includes some dividend we received from the subsidiary, okay? We said over here, they said there was a dividend which the subsidiary paid, 4,000, okay? Out of which we had 3,000, okay? So that 4,500 we have over there, we must subtract the 3,000, okay? Finance costs, we just add them. We get profit before tax. Tax element, just the 2. Don't recalculate, okay? And then we get this portion, profit for the year. Assuming there was no other comprehensive income, we just end it here, okay? And then we find the NCI portion, okay? But we've already calculated. Otherwise, this 145 would have just picked this element 13,500, okay, and represent it here somewhere as 13,500 for the NCI, okay? And then the difference will become that of the parents, okay? The parents' own becomes the balancing figure, okay? The balancing figure, all right. But there was other comprehensive income, so let's add the 2. We get 3,500. We've already calculated the NCI, so don't be tempted. Don't be tempted to apply 25% on this as belonging to the NCI. Don't be tempted to do that. Don't be tempted to apply 25% to say the NCI's portion. NCI is a 25% shareholding, so I need to multiply 25% of this. Don't do that. We've already calculated it here. So the NCI's portion totally for the total comprehensive income is 13,750. Okay, then we indicate it there. Assuming you want to represent this one, you represent a 13, okay, 750, and then the remaining goes to them. Okay, all right. Otherwise, we want to end here. So normally you see profit for the year is attributable to NCI, okay, which goes to our NCI calculation, the standard calculations that we know. And then the difference becomes that of the parent balancing charge, okay. So this is the first portion I want us to look at, okay. This is the first portion I want us to look at. Time is already gone. I'll break this one here for now, and then we'll look at mid-year acquisition, okay. We will look at mid-year acquisition. Okay, so I'm going to end here for the consolidated profit and loss account. Now we'll look at mid-year acquisition again for consolidated profit and loss account, after which we proceed with the other. Okay, good. See you soon. Bye.